Silver gave 250% returns in 12 months, from $32 to $121. Then it did what it always does to the people who got comfortable. It crashed almost 50%, from $121 all the way down to $64. And for the past 6 weeks, it has been grinding sideways between $64 and $90. Chopping, bleeding, frustrating every single person who owns it. Size. The social media crowd has gone quiet. The mainstream financial media is writing silver's obituary. And right now, while all of that is happening, a company called Monetary Metals is offering 12% annualized returns to lease your physical silver. 12%. They are partnering with STONEX, one of the largest commodity brokers on Earth, a COMEX clearing member operating across 40 derivatives exchanges on 4 continents, to borrow physical silver directly from retail investors. Normal silver lease rates run 1 to 2% per year. 12% is 6 times the normal rate. Curious. Here's the only question that matters about that number. If there is no silver shortage, why would anyone pay 12% per year to borrow silver? They would not. Lease rates represent the actual cost of obtaining physical metal in the real market. When that cost runs at 6 times the historical normal, institutions are bidding against each other for every available physical ounce. The paper price says $80. The lease rate says emergency. And lease rates cannot be faked the way paper prices can. That single number tells you more about the true state of this market than any chart, any delivery notice, any vault drain figure. But it does not tell you the complete picture, because there are 3 long-term patterns spanning 21 years, 45 years, and 53 years that explain not just where this market is right now, but where it is structurally pointed, and they are all resolving simultaneously. Stay in. Everything in this video builds on the previous point. Before the data, the psychology. Because understanding the current market requires understanding why it feels the way it feels right now. Accumulation territory does not feel like an opportunity. It feels like throwing money into a hole. It feels like everyone who sold was right and everyone who held was wrong. It feels like the consolidation will never end. That is what accumulation territory is supposed to feel like. If it felt good, everyone would be buying and the price would not be low. The reason prices are low is specifically because the conditions are designed to shake out everyone who does not have conviction in the long-term picture. Every major bottom in this bull market felt identical. Silver at $18 in 2020 felt terrible. Silver at $12 in 2020 felt terrible. Silver at $20 in 2022 felt terrible. Every one of those terrible feeling moments was followed by a rally to new highs. The emotion does not change, only the price level changes. At $80, the emotion is identical to what it was at $18. Fear, doubt, frustration, with one critical difference. At $18, the long-term breakout had not happened yet. At $80, it has. The macro case is structurally stronger now than at any previous bottom in this cycle, and yet the emotion feels exactly the same. That tells you something precise about how markets work. The best setups always feel like the worst moments. Now the 3 long-term patterns, starting with silver, because the 45-year structure is the foundation everything else rests on. In 1980, silver hit an all-time high near $50 per ounce. Then it crashed, and for the next 44 years it built a base. It fell all the way to $4. It recovered back to $50 in 2011, crashed again to $12, recovered to $30, pulled back to $18. Every one of those moves was constructing the same pattern across 4 decades. In technical analysis, this pattern is called a cup and handle. The cup is formed by the long decline from the highs and the gradual multi-decade recovery back toward them. The handle is the final pullback before the breakout. The neckline of this specific pattern, the level that needed to break for the pattern to confirm, sat at $31 to $32, not $50, not the old all-time high, $31 to $32. Silver broke above that neckline in 2024. The 45-year cup and handle triggered. When a cup and handle breaks out, the measured move target is calculated by taking the depth of the cup and adding it to the neckline. This cup is approximately $32 deep from neckline to base. That gives a long-term measured move target of approximately $370. And at the end of a bull market, when momentum overshoots the measured target, the spike target moves above $500, $370 to $500 plus. Not from a 2-week pattern on a short-term chart, from 45 years of price history pointing in a single direction. The 250% move from $32 to $121 that silver produced in 12 months was not the end of the breakout. It was the announcement. The first move out of a multi-decade base is never the complete move. It is the market signaling that the pattern has triggered. The real move comes after the consolidation digests the first leg. Silver grinding between $64 and $90 for 6 weeks is not the story ending. It is the pattern resting between the announcement and the continuation. Now gold, because the 53-year structure adds a dimension that changes the entire interpretation of what is happening. From 1971 to today, gold has made 3 distinct bull moves separated by long consolidation periods. The first started when Nixon ended the gold standard in 1971. Gold moved from $35 to $850, a 2,400% rally. Then 20 years of consolidation. Gold went from $850 to $250 and built a base. The second bull move started around 2000. Gold moved from $250 to $1,920 in 2011, a 900% rally. Then 9 years of consolidation. Gold went from $1,900 back to $1,000 and rebuilt. The third bull move started in 2020. Gold broke above the $2,000 consolidation range and has moved to over $5,600 at the highs. That is already a 180% move, and based on the structure of the previous 2 moves, the third is still in its early stages. But here's the distinction that matters most. Each previous bull move was driven by a specific catalyst. The first, the gold standard ended. The second, the financial crisis and unprecedented money printing. The third is being driven by something larger than either of those. War, inflation, de-dollarization. Central banks buying gold at record pace for 36 consecutive months. Debt spiraling at a rate that has no historical precedent in peacetime. This is not gold going up. This is currencies going down against the one asset that cannot be printed. And when currencies decline against gold in the context of a monetary system under stress, the gold does not come back down to where it started. A new monetary order gets built on top of whatever price it reaches. That is what makes the third bull move structurally different from the previous 2. The first 2 were bull markets. The third is a repricing of the entire monetary system. Now, oil. Because this is where the war connects to everything else. Over 21 years, WTI crude oil has built a specific pattern that technical analysts identify as an inverse head and shoulders. The left shoulder formed around 2008 when oil hit $147. The head formed in 2020 when oil briefly traded at negative $40. The right shoulder has been building since 2020, with oil constructing a base between $40 and $90. Recently, oil broke out of a falling wedge pattern that had been acting as a consolidation structure within the larger move. In technical analysis, a falling wedge that appears midway through a move is called a halfway pattern, meaning the move that preceded it is approximately half complete. 2 independent calculation methods applied to this structure: the measured move from the inverse head and shoulders depth and the halfway pattern projection from the falling wedge produce the same target zone, approximately $369 per barrel. 2 different methodologies, same conclusion, and the fundamental backdrop underneath that technical structure is not ambiguous. The International Energy Agency has stated this is the largest oil supply disruption in the history of the global oil market, not since the 1970s oil embargo, not since the Gulf War. In history, 8 million barrels per day removed from global supply in March alone. Iraq's production collapsed 70% to 1.3 million barrels per day. Kuwait declared force majeure. The Strait of Hormuz, carrying 20% of global oil supply, remains disrupted, and the physical oil market is already separating from the paper price. Physical Dubai crude is currently trading approximately $38 per barrel above its paper equivalent. Jet kerosene hit a record $225 per barrel in early March. The paper price of Brent crude says $92. The physical market says real oil that can be put in a tanker and shipped somewhere is worth $130. That divergence does not persist indefinitely. The paper market always loses the fight with physical reality, because you cannot heat a building with a futures contract, and this physical paper disconnect is not happening in just one market. It is happening across all 3 simultaneously. Silver, Shanghai physical at $94 while COMEX paper prints $80. A $14 gap that arbitrage cannot close because the metal is not physically available to move at the rate the premium demands. Oil, physical Dubai crude $38 above paper Brent. Jet kerosene at record levels. The physical supply chain buckling while the paper price pretends otherwise. Gold, Dubai flights grounded. 20% of the global gold supply chain frozen. Physical gold unavailable for movement through routes that have historically carried it. 3 separate commodities, 3 separate exchanges, 3 separate physical markets, all separating from their paper equivalents at the same time. And underneath all of it, monetary metals paying 12% to lease your physical silver bars. STONEX, a COMEX clearing member with global operations, so desperate for physical metal that they are going to retail investors offering 6 times the normal lease rate just to borrow it. The smart money is not selling silver at $80. They are fighting over every available physical ounce at 6 times the normal cost of obtaining it. Here is the most important distinction in this entire video. The war did not create these 3 patterns. The 45-year silver cup and handle was building long before this conflict began. The 53-year gold 3-drive structure was in its 3rd phase before the first missile was fired. The 21-year oil inverse head and shoulders was forming across 2 decades of price history that predates the current geopolitical situation entirely. The war did not create these patterns. It is forcing them to resolve faster. The Hormuz closure compressed years of oil supply tightening into weeks. The COMEX volume collapse compressed years of silver market drainage into a single month. The central bank gold buying acceleration compressed years of reserve diversification into months of consecutive record purchases. What would have taken years of gradual structural resolution is being forced into months of acute resolution by the geopolitical acceleration. This means the trade does not end when the war ends. The underlying patterns continue resolving regardless of the geopolitical outcome. Peace slows the timeline. It does not reverse the structure. The 45-year cup and handle does not untrigger because a ceasefire is announced. The monetary system stress driving the 3rd gold bull move does not disappear because one conflict concludes. Understanding that distinction is the difference between trading the headlines and positioning for the structure. Now connect all 3 patterns together, because the picture that emerges is larger than any individual chart. Silver has broken out of a 45-year cup and handle. Gold is in the 3rd drive of a 53-year pattern that previous drives suggest is the largest of the 3. Oil has broken out of a 21-year inverse head and shoulders confirmed by 2 independent calculation methods. All 3 breakouts are triggering simultaneously. During the largest oil supply disruption in IEA recorded history, during a bond yield explosion across major European economies confirming stagflation, during the most aggressive central bank gold accumulation on record, during a physical paper price disconnect across every major commodity simultaneously, these are not separate stories. They are the same story told across 3 markets from 3 different angles. The fiat currency system that has governed the world since 1971 is being stress-tested at a level it has not experienced since its creation. Gold is pricing that stress. Silver is pricing it with leverage. Oil is pricing the physical reality that underlies every economy that runs on energy. Every generation gets one moment when the long-term patterns align with the macro catalyst. The people who positioned in gold in 1971 when the gold standard ended captured a 2,400% return. The people who positioned in 2000 at the start of the second drive captured 900%. The people accumulating physical gold and silver during this consolidation are positioning for the third, and structurally the most significant, move in the 53-year cycle. The bear case is real and gets full precision. The $370 silver target and the $369 oil target are mathematical outputs of long-term chart patterns. Charts give targets. They do not give timelines. The consolidation between $64.4 and $90 on silver could extend significantly longer than anyone expects. Paper markets can suppress prices below where physical fundamentals say they should be for extended periods. As the lease rate and delivery data confirm, the DXY sustaining above 100 and pushing toward 102 or 103 puts direct downward pressure on every dollar-denominated commodity simultaneously. In that scenario, silver tests the low 70s and potentially revisits the $64 consolidation low before the structural patterns force the resolution. The $80 level must hold on a closing basis. Below $80, $77 is the next structural reference. Below $77, the $64 consolidation base comes back into discussion. The 45-year pattern does not guarantee a straight line from $80 to $370. It guarantees the direction, not the path, not the timeline. Do not mistake conviction in the long-term structure for certainty about the short-term price action. Size positions to survive the paper market noise between now and the physical resolution. Here is what to watch. Watch silver lease rates. If monetary metals and STONEX are paying 12% to borrow physical silver, that number is a real-time scarcity indicator that cannot be manipulated by paper market mechanics. If that rate rises further, physical desperation is intensifying. If it normalizes back toward 2%, physical supply is responding. Watch the DXY at 100. Every session that holds below 100 on a daily close adds evidence of the historical ceiling holding. Every session that closes and sustains above 100 with momentum toward 102 extends the paper market pressure on all 3 commodity patterns simultaneously. Watch COMEX delivery notices and registered inventory daily. The registered inventory level relative to open interest remains the most direct measure of paper to physical stress inside the futures market. Public and updated every session. Watch the Shanghai premium direction. If the $14 gap between Shanghai physical and COMEX paper continues widening, The physical disconnection is deepening. If it begins narrowing, arbitrage flows are finding metal. The direction of that premium tells you more than the absolute price level. Watch European bond yields. UK gilt and German bond yields staying elevated while their economies contract is the bond market pricing the inflation wave that has not yet fully reached consumers. That forward signal from the most sophisticated pricing mechanism in global finance is the leading indicator for what CPI data will show in 3 to 6 months. Here is where the market stands, silver at $80 after giving 250% in 12 months. Monetary Metals and STONEX paying 12% to borrow physical silver from retail investors, 6 times the normal lease rate. The 45-year cup and handle on silver triggered when the $31 to $32 neckline broke in 2024. The 53-year 3 drives pattern on gold in its third move, the one driven not by a single policy change but by stress on the entire monetary architecture built since 1971. The 21-year inverse head and shoulders on oil confirmed by 2 independent calculation methods with the IEA calling the current supply disruption the largest in the history of the global oil market. 3 patterns, 3 assets, all resolving simultaneously, and in the physical market underneath all 3, Shanghai paying $14 above COMEX, physical Dubai crude $38 above paper Brent, jet kerosene at record levels, and institutions paying 6 times the normal rate to borrow physical silver. The paper markets are telling you one price. The physical markets are telling you a completely different one. Lease rates do not lie. Delivery data does not lie. Physical premiums do not lie. The paper price is temporary. Physical reality is not. The 45-year chart does not care about this week's dollar move. It does not care about the Fed meeting. It sees the long arc of what is happening. And the long arc says the consolidation between $64 and $90 is the pause between the announcement and the continuation, not the end, the middle. Verify everything. Silver lease rate data from Monetary Metals is publicly available. COMEX delivery notices and registered inventory are updated daily and publicly accessible. IEA supply disruption data is published on the agency's official platform. European bond yield data is available on any public financial terminal. CME FedWatch rate probability tables are updated in real time. The data is public. The patterns are visible. The physical market is already pricing what the paper market has not yet acknowledged. The only question is whether you see the 50-year chart or only the daily one. Invest with logic, not hype. Market Crux. Signing off. Market Crux. All data independently verifiable, not financial advice.